to our Law Business Finance webinar. We are going to continue from where we left off. I know we have covered up to the trial balance, but at our level, we have to cover and continue and be able to prepare financial statements, and we should be able to interpret the financial statements. So in this webinar of ours, I'll continue with the trial balance that we prepared together, and I will illustrate to you how to prepare financial statements. And this is covered by pages 76 to 81 of our schedule. So let me just share our PowerPoint presentation. Okay, so we'll come back here. So we are going to continue and do our financial statements, pages 76 to 81 of our study guide. So please, may you go through it so that you can consolidate what I'm going to quickly say on this webinar. This is our last webinar, and I hope it will be very beneficial for you. At this stage, you really need this information, and you as business people, it will be very beneficial for you to be able to interpret your own financial statements. Okay, so with financial statements, what we have, we've got what we call annual financial statements. So with annual financial statements, these are financial statements that are prepared for 12 months. Okay, so remember we spoke about our financial periods. So each entity should have a defined financial period. For individuals, remember we spoke about from March to February of the following year. So if your March is starting this year, your year would end in February. So for those 12 months, when you prepare the financial statements, they are called annual financial statements. So just go through the start guide and then you will see what is required. But at the same time, what I will do is that I'm going to do an illustration of annual financial statements so that you can just have a feel and also be able to more of like interpret. Our trial balance does not have a lot, but we'll just prepare from there. Okay. And why do we need annual financial statements? So financial statements are required for reporting purposes. So for any business that is operating, at the end of the day, we have to compile financial statements. And then with those financial statements, we utilize them. The first thing, for the firm itself or for the practice itself to determine its performance. So you cannot trade just without knowing what is happening, because you will not be able to continue, and you won't be able to give reasons why you're doing so well, or at what level you're doing so well, or why the business failed. So you can only see that by preparation of what financial statements, especially the management accounts, which are done on a monthly basis. Okay, so internally, financial statements, they are very crucial. They will give you an overview of what is happening over the 12 months that you've been operating. And the good thing about annual financial statements, they are prepared with comparatives, which means you have got your prior year financial statements compared in the same page with the current year financial statements, so that you can see the performance of the business. So as a business person, you should be interested in seeing the financial statements. You should not look at it as a way where you say it's a thing that will take money from you. But no, it is a very good tool that you use for control purposes, for like what we spoke about bookkeeping, all those benefits of bookkeeping, like you would know your debtors, you know your creditors, your financial position, and for reporting purposes, like what I've said. Okay, and who else do we report to? So we also report to our banks. So for banks purposes, like now there's FIC, which is FICA, With FICA, you find with the banks, they are required to determine where your source of income is. So normally they would request you to produce your financial statements. And also, if you want financing for your business, say for instance, you are looking for a loan, it can be a business loan, it can be an overdraft, it can be an asset finance loan, it can be a mortgage loan to buy offices. So with the banks, for them to advance you that money, they want to see the financial position of the company, they want to see the financial performance, they want to see how you manage your cash flows. And also they will need bank statements as well. So how you conduct your business is how they will be able to finance you. They'll be able to assess and then be able to finance. So normally they would ask for three years financial statements, or they can ask for 2 years end management accounts. And also they also want to see how the directors are performing, and they would request documents like directors tax assessments. Okay, so with the director's tax assessments, which means you need to be serious in managing your business, where you ensure that you also earn a salary. If it's a sole practice, you constantly take a drawing that when you want assistance in the future for business purposes or for personal purposes, then you are able to produce these documents. Don't just run these practices willy-nilly and then you say, I don't want to pay SARS. It has got a future huge implication. So make sure that you prepare your financial statements and they are there for future use, especially for financing purposes. If you want an overdraft, they will ask for financial statements, they will ask for management accounts. And for SARS purposes, you would find with SARS, they require financial statements. And the reason why they require financial statements, every entity, every business that is formed in the Republic is supposed to pay tax. The main objective of a business is to run at a profit. And with a business running at a profit, the share of that profit goes towards tax. And as we are business people, we are responsible citizens, we live according to the laws, to the act, and law is what you guys do. So I encourage you to consider these things. You don't want to wake up one day and then you realize there is SARS knocking at your door and then they are saying you're not compliant. So please ensure that you prepare your annual financial statements, you do your taxes on a 6 month basis, on a yearly basis. When you are supposed to register for VAT, you ensure you register. When you're supposed to register for pay as you earn, you also register. So annual financial statements are very crucial. And then also the reason why we need annual financial statements, we need them for tender purposes. So for those businesses that are into commercial work and also tendering, you would find you are constantly required to produce your annual financial statements. So how do you produce your annual financial statements when you're not preparing them? So don't ever think that it's a big financial outflow. Budget for it. We will do budgets together. So you will see you need to budget for audit fees, you need to budget for accounting fees, so that at the end of the day, you are able to present these financial statements when required. Okay, so they are very useful. Okay, and these are annual financial statements, and there is what we call interim financial statements or management accounts. So like what I've said, for the annual ones, they are prepared over a 12-month period, but the interim ones or the management accounts, those are the ones that we prepare like on a monthly basis. So when we prepare them on a monthly basis, so month one, say for instance, your period is from March up to February. Month one will be March, month two will be April, month three would be May. So when you are running, then you are going to have, say if you want 3 months management accounts or interim, then you are going to prepare them as at end of May. So you prepare them at the last day of the month, last day of the month. So for banks, you find they want them, especially if you have traded for more than 3 months or 6 months for purposes of financing, they will say, give us the current position. And that current position is shown in the interim. So it's interim, it's not yet a year or it's management accounts, because usually management utilize these financial statements for their decision making. So you need to be informed. You can only be informed by constantly preparing management accounts on a monthly basis so that you can actually see how the business has performed. You compare that with budgets that you would have set at the beginning of the year, and then you see how the business is performing. You remember, finances are the blood flow of the businesses. They're the blood flow of the business. So without knowing your finances and just relying on a bank statement, then you find you will not have much control over the business, over the assets of the company. Okay. Okay, so like what I've said, they are prepared during the year for the given months. So if you are in October, then it's like period 8. So you will say, I'm preparing management accounts for 8. It's October, yeah, for 8 months ending 31 October 2024, 2025, 2026, just like that. So that's how you prepare them for 10 months or for 6 months ending August, just like that. And then you show them some of the management accounts, the format, they are prepared on a monthly basis. Some, like the banks, they don't mind you to consolidate and have everything. You show your turnover for those 10 months and you compare it with the prior year. That's how banks, we want these things to be presented. And of late, they prefer them to be prepared by accountants, unless if you have an in-house system that is reliable. Okay, and when it comes to management accounts, they are normally required for financing purposes by banks and for internal analysis of performance, financial position, okay, and also for tax planning and reporting. So tax planning, like what we have learned previously, we have noted that there's provisional tax. Provisional tax, it's an estimate of your profits. So when you go towards the year end, you have to submit like every 6 months. So when you go towards the year end, the taxman expects you to at least be within the 90% range of actuals. So the actuals can only come from your management accounts. Okay, so you need to take this seriously because it's something that is very good for reporting purposes, and you need to check on people who are preparing these financial statements. So the next thing that we are going to do, we are going to have an example on financial statements. Okay, so we are going to continue with our TB in our workbook. The previous webinar that we have had, we continue with that, and then I am going to illustrate how we are going to prepare the financial statements. Okay, and what you need to know, financial statements, they consist of one. So it's a big document. It can be like an 18-pager document, 16-pager, 14-pager, depending on who is preparing the financials and what information you need to show. Okay, so usually they have a cover page. Okay, and then they've got an index which shows the page numbers. So that's our index. The third one normally would show the business information. So like for example, we show the nature of the business, we show the directors, the address, the bankers, the tax number. So we show that in the third page. And then the fourth page, usually it's the director's responsibility to show that they are responsible for the financial statements. And the third, usually it's the accountant's report. So that's the fifth, the accountant's report. And then from there, we then get the directors just to comment a commentary on the financial statements. And then we then start having our financial statements which show the financial figures. And in these financial figures, the sequence, usually we start with the statement of financial position. So financial position, it is showing at a particular date. Say on this date, this is the cash which was in the account, this is the value of the assets, this is the value of the inventory, these were the debtors that we had, creditors, things like that. So I'll show you when we are preparing. And then the next thing that we show, it's a statement of comprehensive income. So we also show this. This is now the financial performance, income and expenses, but in a summarized way, because the last page is the one that would have the detailed income and expenses of the business that feed into this comprehensive income statement. And then from there, we've got what we call a statement of equity. And then from the statement of equity, we've got a cash flow statement. And then from the cash flow statement, we've got our notes. Normally, we have our accounting policies. So each entity should have accounting policies where it defines when we are depreciating our assets. Say, for instance, motor vehicles, do you adhere to the SARS rates or you've got your own internal rates? So if you are adhering to the SARS rates, motor vehicles are depreciated at 20% per annum, which means they're depreciated over 5 years. And if you take your furniture, it's depreciated over 6 years, which is like 15 point something percent. And if you take your land and buildings, it's usually over land, usually not depreciated, buildings over 20 years. So it's those things that you can then adopt from the tax act. And if you are using a system that prepares the financial statements, you would find all these notes there inbuilt. So you're just going to select what suits your organization. And then from these accounting policy notes, then you continue to the notes that support the balance sheet or the statement of financial position and the income statement to just give more detail. And then from there, the last page is your detailed income statement. Okay, so with me, I don't have an illustration of all those pages, but if you can Google an example, a template of financial statements, you'll be able to see financial statements. But what I'm going to present to you, it's the financial part, which we are going to work on based on our trial balance that we prepared. Okay, so I'm going to stop sharing here and I'll share the worksheets that we're working on. Yes, thank you. Okay, so let's go to our worksheet. So it's our week 2. Week 2. Okay, so this is our workbook 2. So I hope you are able to see it. Sorry for taking a bit of some time to share. Okay, so this is the layout of our statement of financial position. So remember, like what I've said, the financial position shows us at a particular date. So say, for instance, we are looking at 28 February 2023. So our financial statements would have stipulated that this is 28 February 2023. So when they are being prepared, you find they also show a comparative of that particular period, which is what 28 February 2022. So this is the layout. When I say comparative, it means figures for the both periods. Okay, and okay, and then the next component would be our statement of changes in equity. So I've just drawn a simple kind of like a layout. So this is it with its comparative. It will show our fees for the year combined, our operating expenses combined, finance income, finance cost, and then the net, and then the profit, and then the tax. So if it's for a sole prop, the profit usually is not calculated here because then the profit it's then going to be calculated under the practitioner. But for an incorporated, then we show the taxation, the tax expense, and then the net profit. Okay, and then I'll illustrate. So what we'll start with, this is our trial balance that we worked on. So we want to develop from our trial balance going forward so that we can just do a mini example. Okay, so I will start with our detailed. This is our detailed income statement. Obviously, we won't have our comparatives because we don't have figures for that. But from here, we're going to develop based on what we have. Okay, so we start with our fees. So our fees, remember, if we go to our trial balance, our fees, here they are. These are our fees. Let's assume, okay, you remember I said financial statements can be prepared for a month, for 2 months as management accounts or as interim financial statements, or they can be prepared for a 12 months period. So whichever way, it will add up to the same. So these are our fees. So we take our fees. So if we had other income, then we would show the other income. In this case, I don't think we have. And then we look at our expenses. So we go to our trial balance. This is where we are getting our expenses. This part forms our expenses. This is our expenses. So I'm going to copy our expenses. Then I'm just going to paste them here. And these are basically our expenses. I'm going to remove what is not part of our expenses so that we prepare a cozy, a detailed income statement like that. Okay, and then we start with our insurance because it's given, so we can put a minus sign because it's an outflow. So onto our trial balance, we pick the expenses just like that according to the way that we worked out that. And then I'm going to pick the last expense, which is the traveling, like that. Okay, so if you can have a look, sorry, if you can have a look, let me enlarge this so that you'll be able to see. So if you can have a look at this, this is our fee for this period, and then this is these are our expenses. So now, as you can see already, we now have our profit. So we can see for this particular month, or if it was a month thing, or if it was a year, we at least made a profit. So now we are able to make a decision. And for our entities now, you find the income tax has been reduced from 28% to 27%. So just like that, we apply the 27%, unless if there are other things that are not allowable as expenses by SARS. But in our case, all these expenses are allowable. If there were any penalties, if there were any fines, then those ones, they are not allowable. They are considered as wasteful expenditure, and the taxman does not accept them. Okay, so in this case, we can even determine the tax that is payable in this period. We then are able to set it aside or put it in an investment account so that when the time comes for us to pay provisional tax, we've got all our tax in place. Okay, so that's how I say then it helps with decision making, with internal decision making, and with tax planning, because then you can plan, put aside, and make sure that you pay. Okay, so this is our detailed income statement. So the detailed income statement, it feeds into our statement of comprehensive income. How does it feed? Our fee, it's the same. So it's picking our fees, and then our operating expense. Now these are now summarized. So we are now summarizing, is the summarized information. And then from there, finance, if we had any interest, then we would show it. We'll pick it from our detailed, but we don't have. And if we had any finance costs, then we would show them. We just want to show operating expenses without the financing part. So that is the idea. Then it shows, like already we've got formulas which are given, and then it picks. And if you can compare, then we've got the same information, 4798. The only thing that is left is for us to compute the tax payable. That is the tax payable. And at the end of the day, we are left with a profit of 35025. So the two sheets, this is just a summary of the detailed income statement. This is how we prepare our financials. And then from there, we have what we call a statement of changes in equity. Changes in equity, remember equity, we said this is the owner's contribution plus profits and losses that are accumulated over a period of time. So here we are. So the owner's contribution is called share capital. So also it shows comparatives. So this is the previous period up to here. So if we had a balance, then it would show our balance. And in our example, I think we were given our closing equity, we were given for, if we can check in our trial balance, here is our retained earnings. Okay, here is our share capital. We are also given the one that I wrote equity. It was a mistake. I was supposed to write share capital. I was not supposed to write equity. It's supposed to be share capital like that. So if we go back even to our ledger, this ledger which I wrote equity, it's supposed to be a share capital. This one, I was supposed to write equity here because it is like a section for equity. Okay, but it's called share capital. Share capital. So shares in a business, what a shareholders contribute are called shares. They are split into, like, if it's 1,000, like a 1 rand share, so that people are able to buy out of that batch, and then they are part of the ownership of the business. They are called shares. And then shareholders are the ones that contribute the capital. Directors are the ones that direct the business. So with a law firm, like what I've said, you cannot be a director without being a shareholder. No, sorry for that. You cannot be a shareholder who is not a qualified attorney or advocate. I'm not sure about that part, but we need to confirm it. But you need to be a qualified attorney. So directors are the only shareholders, but you can be a director without having any shares in a business, shares belonging to the founders or the people who started with the business. So you can be appointed as an associate director or just as an operations director or a finance director, but you have to be an attorney for you to be a director, but you are not a shareholder ultimately. Okay, so that is the difference. So on our company registration documents, what would appear, it's the directors, those people who are going to be in control of the business. Directors control the business, they direct the business, and then they are given portfolios in which they are supposed to direct according to the structure of the company. Shareholders, they put in money. Okay, those are the difference. So when you are asked by banks to prepare shares, that is how you prepare the shares. So we were on the statement of changes in equity, statement of changes in equity. Let me more of like write it here for you. So it's called statement of changes in equity, like that. Okay, so then it comes, this is our equity. So I'm going to kind of like just put formulas so that it can pick. So share capital will move from one year to the other. And then the closing year, it depends with the profit that we had opening and then the profit that we had in this year. And then we then pick up our current year profit. Where do we pick it up? From our statement of changes in equity. So this is profit for the year, then it comes. And then what we do, we add up. So this and that, they give us 139. Overall, plus our share capital, we then get 140. So this is what we are going to continue rolling forward for each period. Okay, so just ignore, this is the format that we normally use, but it all depends with the periods that we are preparing in. I think we were in, if I'm not mistaken, we were in August, so it could be these ones are interim financial statements, but I'm just taking an example illustrating for you guys. Okay, so from preparing our statement of changes in equity, so normally from there, then we prepare our statement of financial position. So our statement of financial position is basically our balance sheet. So it's called our balance. It used to be called balance sheet. And then because of changes that are happening in the accounting field, they've changed it to statement of financial position. So it shows the financial position of the entity. So statement of comprehensive income, it's normally called, it also is called statement of financial performance. Statement of comprehensive income or statement of financial performance. So it shows the performance of the business. Performance, income less expenditure, anything that we're going to pay as expenditure, then it shows the performance. How is our business performing? Are the fees exceeding the expenses? Where are we standing? Are we sitting with a profit? This is the statement. And then this one is the financial position. So the financial position is to tell us the assets. So in our example, when we go to our trial balance, we were not given any information on fixed assets. So our fixed assets are our motor vehicles, our furniture, our computers, our and other printers. So that is our what we then call our property, plant and equipment. And with the property, plant and equipment, you can see they fall under note 2. So if you go on note 2, then you will have, like you can see, it reconciles the assets of the business. So if we had computers, we would come and capture them here. If we've got office equipment, we'll come and do the reconciliation here. Okay, opening balance, if we've got any additions, if we've got the depreciation, then we come up with the closing balance. And we also show the previous year, the same movement, which feeds into the current year. And then also, this is the same, so the note is so detailed. It would also show another method where we've got the cost, the accumulated depreciation over the years, and then the carrying amounts for the prior year. And then we also show for the current year. And then when we show for the current year, this figure that would have been here should be the same as the figure that is there. So this is a reconciliation of the part on top. And these figures are the ones that then go into our financial statements. This would be our comparative for the prior year. And then we take them, they go to our financial position. They come here, we feed them. This is the prior year. This is the current year. Okay, this is how we would have done our reconciliation. Okay, happiness. So let's do our cash and bank. So our cash and bank, we go to our trial balance. If we can have a look at our trial balance. Okay, this is our business bank balance. This is our petty cash balance. If we add them, they are called cash and cash equivalent. Okay, so it's cash which is readily available. Okay, so when we go to our balance sheet, statement of financial position, we pick them. They are called cash and cash equivalents. We pick them. That is our cash and cash equivalent. We add them up, then it shows. And in our trial balances, you can see we've got our debtors. These are our debtors. Okay, this is our cash, this is our debtors. So which means in our balance sheet, we need to show that we've got debtors. Okay, so I'm going to copy this, insert, okay, and then we normally call them trade debtors or accounts receivable. Trade debtors, trade and other debtors, or accounts and other receivables. So say for instance, other stands for prepayments. If we prepay our suppliers or if we advance our employees, then we call that other debtors. other receivables. Okay, and then normally they come with a note. So for instance, we've got a note 2, and then here becomes our note 3, then this would be our note 4. So why we are making them to be, okay, let me undo. Why we are making them to be on top there, it's because when we are looking at the balance sheet flow, we should start with things that will get cash later. So it's our non-current assets. As we move into our current assets, we categorize them in such a way that we start on top with the ones that are difficult to collect until we get to our cash, which we know it's readily available. So that's how we do our structure, the way that we were taught. Though at the end of the day, the most important thing is just for people to understand. And how do we distinguish between current and non-current? The way that we distinguish between current and non-current, it's we are looking at a 12 months period. So when you look at the property, plant and equipment, we have it for a period of time like 5 years, or we have it for the coming 20 years. So we put it as non-current. It's there. We don't have to sell it. It doesn't turn into liquid like now. If we are to sell it, we are not even thinking about selling it. So it's something that will carry over for the coming more than 12 months. And then with our trade debtors, we expect our money to be paid within 12 months. Okay, we expect our money to be paid within 12 months. Hence, we put it under current. That's how we say this thing is current. Okay, so debtors, they take longer to be collected compared to cash and bank. So we put them on top towards the non-current, and we put this. And if in our debtors, we can analyze further, and then we can see that there are debtors which are like now more than a year. So with those ones more than a year, and we've got hope, we don't want to write them off yet. We've got hope of collecting. So with those ones, then we categorize them under non-current assets because they are no longer current. They make it difficult for us to make a decision. Because if we lump everything, we anticipate to receive this 78,000 within a month, within 3 months, or within 12 months. In this case, it will be within 12 months. But if we see we are not going to get over 12 months, then we make it non-current. Okay. So in this case, these are our assets according to our example. These are our assets. So these are the business and their current assets. Okay. This one is our fee. We've dealt with our fee. Okay. I'm going to put it in green. All right. Here, I'm going to highlight it rather in green like that. In green like, yeah. Technology today is giving me, yeah, like that. Okay, and then we look at, okay, if I can have a look, I think I had a mixture. We have a disbursement recovery. So disbursement recovery, it's like other income. This one, it's also part of our other income. So when we go to our detailed income statement, we are supposed to have it as other income. It's our other income. Sorry, I had missed that part. It's our other income. It increases our income because it is going to reduce our expenses. There are those expenses that we pay, your deed office, your, okay, then it reduces. If we capture them, then it reduces our expenses that are belonging to the client. Those are business client meta expenses, so they are reduced by these disbursements. And when we come to our summarized, then it means we have to have other income as well. It's not our fee, but it's a recovery of an expense that we've incurred. Other income. So the reason why we split it is because then when it comes to VAT, then we do not have issues with accounting for VAT. As you can see, I have added so that we come here to the 49, and then they are matching. And this 36, then it feeds into our statement of changes in equity. Then we come back here. So when we come back here, you will see we've got what we call retained income. So when you go to the top balance, okay, we've got our share capital retained earnings, which are these ones. I'm going to highlight them like that. Like that. Okay, so this is our equity. Okay, this is our equity. I'm going just to move it up. I'm rearranging our trial balance according to category. This is our equity. These were our fees, our equity, and then now we are moving into categorizing our current liabilities and our long-term liabilities. So this one is current liability, which I'll highlight purple. It's dark. Okay, let's highlight it red. And then this is our director's loan, which is long-term, because we assume the director is not going to demand his money like now. Okay, let's start with our share capital. So when you come to our share capital, it's called share capital. It's there. It has to be disclosed on the face of the balance sheet. It has to be disclosed on the face of the balance sheet. So we disclose it like that. And our retained. So we remember we were given opening balances. So with our opening balances as well, one can be able to also compute the comparative. Say our opening balances were coming from the other position. So our trade debtors, when we go to the debtors ledger, we had I remember with Dr. Jane we had 90,000. That was our opening, and then with our cash, if we go to the cash book, we had an opening balance. Our business with an opening of 53. So those are our comparatives. And then retained earnings, we also had an opening, which the trial balance is there. This is our retained earning. Okay, and equity with opening balance. So equity value just remains, so which is also the same here. Okay, and our movement for the retained earning, it's accumulating, so it peaks with the current profit. So where do we get it? We get it on our statement of changes, which is this one in this column. So then it accumulates, it peaks, then it comes here. Okay, and then from there we've got the long term. In this case we go, so this would be our note 5. This would be our note 6. So our shareholders loan, which is the same as more of like the director's loan, and in this case it's 36, and we didn't have any movement on that, so I'm just going to pick the same amount. But if we had a movement, I was going to go to the opening balance, which is in the general ledger. I check under director's loan, and then we take the opening balance, and then the movement, the closing balance is the one that would take here. Okay, so if we can have a look here, our formula, I don't think it's adding up properly. Our formula is not adding up properly. If we go there, our formula also add up properly. Okay, and for the prior year balance sheet, if we can compare this less that, like that, we're having a difference of 2013. I wouldn't know what caused the difference, but our question should have made us balance, because at the end of the day we balanced. I think with a creditor, so let's check under I don't know if we had an opening VAT balance. No. Our question, I will have a look at our question and then see why our opening balance is not balancing, but it should more of like balance, because we just picked from our question and we had creditors, we had general creditors. Remember, we had an opening balance on a Switchtel. We also had an opening balance on Windit. So these two, if we add them up, they should give us that difference. So if we go to our statement of financial position, then the next thing that we should add is the part of the short-term, the non-current liabilities, and this is where these creditors will fall in. So I'm going to make this, change this to non-current, sorry, to current. It's our current liabilities. So our current liabilities, those are the liabilities that we expect to settle within trade and other payables. We expect to settle them within the coming 12 months. And yeah, our trade and payables. And then we also have our income tax payable, like that. Okay, so I'm going to delete like that. And then when we come to our trade payables, so we had said we've got opening date, opening creditors. So if you go to our creditors with these opening balances that we had, so I'm picking them. So then they form part of our comparative. So when we come here, this is the formula, we add them up. And if you can compare, this is our comparative, it was 143, 143. Then we have balanced. So we do a control to see if we have balanced. So we've got what we call non-current assets, current assets. We've got non-current liabilities, we've got current liabilities. Okay, so with banks, they analyze these figures. They've got ratios that they analyze, and with analyzing those ratios, they can be able to tell you whether they are going to give you a loan or they are not giving you a loan, especially your current assets. Your current assets are supposed to cover your current liabilities. So in this case, let's look at our trade and other payables. If we go to our trial balance, did we have any? Yes. Which ones? Now we only have our VAT payable and our pay-as-you-earn payable. Those are part of our trade and other payable. So normally then we would come up with a note, like note 7, then where we explain we've got VAT so much, we've got so much, then we add that up, and then it's part of our notes. Let me correct my payables. Okay, and then that's our note 7, and here our formula, we should make sure that then our formula adds up. Okay, and when it comes to income tax, it's coming from our, we've worked it out in our statement of changes, which is this one. So that's what we pick. We are owing the taxman income tax. So if you can look at our balance sheet, assets is equals to equity plus liability. So our equation, our accounting equation, remember our accounting equation, assets equals equity plus liabilities like that. Okay, so our assets, if we come to our assets, you see our assets, it's your current assets plus non-current assets, which is that one. So this is our total assets. Okay, and then our equity, that is our equity, which is this one. So already even we are given total equity plus liabilities. So if you can compare them, it's the same amount. Our liabilities, that is our liabilities, it's this one plus that one. Okay, so if you can compare, I think I'm in the wrong column. on a wrong row. Like that. I'm just going to do a bit of cosmetics. Okay, like that. So our equation then balances. This is where we apply our equation. 209, and if we add this up, you'll find it's also 209, 200. So assets is equals to equity plus liabilities. So for us to analyze our assets, okay, so we are saying our cash, it's because we had an opening balance of our cash, which we seen in the trial in the cash book. We had 53. It's coming from, it's going on, it's continuing. We've got our opening balance, which is then also supported by our retained earnings. So it's money coming from previous periods that we are continuing to carry. And as we carry it, then it's also kind of like supported by our balance sheet. And as part of that money, it's also because the part of it, it's sitting in our debtors. Okay, it's sitting in our debtors, and our debtors have paid. Now you can see our debtors are now less. So when you are comparing prior period, you can see our cash value, our cash has gone up compared to what we had at the beginning. Why? Because our debtors have paid, and we are sitting with lower debtors. We are collecting more. We are collecting our debtors that are turning into cash, and our retained earning, it's growing. Then we are making a profit. It's because we are making a profit. Okay, and our shareholders loan remains the same. We haven't paid the shareholder, we haven't done anything. So okay, and then our trade and other payables, they've grown. Why have they grown? Now we've got VAT, and now we've got income tax. So as part of the money that we have in the bank, we'll need to utilize it to pay VAT, pay as you earn, income tax. Okay, so those are our current liabilities. So when the banks look at our position and see we've got 209,200 as part of our current, and then this is only what we are owing, then they are able to advance us if we are looking for a loan. And even SARS, when they look at this, we are able to pay our taxes. We are not being negligent. We are keeping the money in the account. Okay. And the other thing that I told you, when you are sitting with a lot of money like this in your cash book, you are not earning any interest. You are not getting any income stream, passive income. So you can decide and say, oh, okay, the 100,000, let me put it in a savings account, in an investment account, 48-day account. When I want money, after 40 days, I receive it, or I put it in a call account. When I want money, you can split it in a call account, and then you put some in a 7-day, but then you give 7 days so that you don't lose out on the benefit of keeping money there. So you look at your money habits. When do you require money? If I require it in a month's time, then you call it from the bank. It comes back, then you pay your tax obligation. So that when you want to pay your taxes, you know your taxes are due every 6 months. You don't want in August, then you say, but the money is sitting in a 32-day account. You see, then you take it, you lose that interest, or you take it, you pay SARS after August, then you are charged 10%. That's big, that's huge for a business. So us as directors of these companies, as the practitioners, we just have to make these decisions that are good for our businesses, that are good for continuity. Okay, so these are our financial statements. And then when it comes to our cash flow, okay, that is the next thing. The cash flow, it's prepared, it's the cash movements. And in our example, unfortunately, we did not do any, we don't have any assets. So the movements are kind of like limited. They are easy to do. So there are two methods. There's a direct method, there's an indirect method. So in this case, I'm just going to show you an indirect method of doing our cash flows. So we start with our profit before tax. So we take it from our income statement or our statement of comprehensive income. financial performance, we take it from there. So if we had depreciation, we're going to show our depreciation. If we had paid tax, we show how much paid tax, exact tax that we have paid. These are cash movements. And as part of our cash movements, then we show movement in our debtors and creditors, because remember, we had an opening balance. Now they are paying us. When they pay us, then that is shown in the movement. So in our accounts receivable, which is our debtors, we go to our balance sheet. Okay, so we had 90, okay, but now we are sitting with 78, which means we have received money. So we are tracking the money movement, the receipt of money. We have received from our debtors overall 11,750, we put it. And then from our creditors, we take our creditors position. Okay, so we are sitting with creditors, which means we did not pay them. You see, we were sitting with 2,000, but now we have got 18. So in our cash flow, we have not paid our creditors, which we are sitting with their money. Okay, we are sitting with their money, so we take that, we less. So it gives us a positive cash flow because we did not take out what we were supposed to take out. If we had paid them, we would see an outflow, which is a negative. Okay, and then if we had any purchases that we had done for assets, we call it investing. Now we're investing into the business. Did we buy any assets? Did we dispose? Then that movement is shown here. So the top part is the operating part, the operation of the business. And then if we invest into assets, into any investment accounts, we show that movement here. Okay, the next part is our cash flows from financing activities. Did we issue new shares? In our case, our opening share capital is the same as the closing share capital. So we didn't do anything, we didn't issue any shares. And then the shareholders, did they increase the loan? No, they didn't increase the loan. Okay, so our position is more of like the same. So sometimes you can then just go to your balance sheet just for formula sake and for completeness. You go, you say, okay, this is our balance sheet. This minus that is the any movement, nothing. Our share capital, this minus the opening is the any movement, no movement. Okay, then we look at the increase in cash or the decrease. It can be a movement in cash and cash equivalents. How do we get our movement? We take our operating profit, which is basically all these items. Okay, working capital, it's made up of debtors and creditors, inventory, we add them up, and then we add these to get our 77,200. Then if we had investing, we add operating plus investing plus financing, then we get our movement. So in this case, we only have one line item, which is the 77. And then we look at our cash and cash equivalent at the beginning of the year. So normally it feeds here, which is our closing cash from the previous period. Where do we get our closing cash from the previous period? We can check in our balance sheet or statement of financial position, which is this one. Okay, it should balance. So at the end of the day, if we can compare these figures like this one, we do our checks. Where do we compare? It's unfortunate I picked from the balance sheet, but I'm not supposed to pick from there. And then this one we compare with our balance sheet because we're working it out like now. Okay, you can see our cash flow is balancing. This is our cash flow. You can go back, you can rehash, you can check. This is how we come. So it's cash items, it's cash movement, cash that we had at the beginning, plus the movement in cash. Then we have our closing cash. Okay, happiness. And then we go to our notes. We've done the property, plant and equipment note, and then we do the other notes. So notes are determined by our statement of financial position. So it's a matter of the incoming. If we've got trade debtors, trade and other debtors, we split and say what are the trade debtors, what are the other debtors. Then we show we've got prepayment, we've got VAT, we've got do a reconciliation, cash and bank or cash and cash equivalent. We say, okay, we can then say we've got cash at the bank, and then we've got petty cash. Okay, then we move our share capital. Usually it stays the same, 100 shares at R1 each, or 1,000 shares at R1 each. Okay, and then shareholders loan. If there were no movements, then we show the shareholders loan. I'm not going to cover much on notes. It's just to give more detail on the balance sheet and the income statement. If it's revenue, we'll then come and show our legal services revenue. We pick it from our statement of changes, in our statement of comprehensive income. We feed it into the notes. I'm not going to cover much because I won't be able to finish, because I want to move on to budgets. Okay, these are our financial statements, our balance sheets, or statement of financial position as it is called now. Let me give a pictorial view. Okay, total assets made up of non-current and current assets, and we've got our equity, we've got our non-current liabilities, we've got our current liabilities, then we have our total to give us that equation, accounting equation. If you can go back to our notes, you will be able to pick it from there. Okay, and then our income statement, fee, income, our detailed, we show the detailed line items. So from our detailed line items, this is where then we can utilize this information of the detail to prepare our balance, our budgets, which is our next topic, which is our next and final topic that we're going to do. You've got a question on budgets, so they emanate from here. I'm going to stop, save this, and then I'll stop sharing, and then I'll come back and we share our budgets. Okay. Okay, our next, it's budgeting. Okay, we are going to look at budgeting. Budgeting is very crucial for any business, very crucial for operation of any business. We are looking into the future. We are planning ahead. We want to make sure that when we are working, we are focused. So we work looking at figures that we anticipate to achieve. And how do we do that? We do that through budgeting. Okay, and budgeting is very involving. So how do I say it's very involving? You need to liaise with every department so that you get the information. It's unlike the actuals. The actuals, we get them from historic information. It's historic. But this one, it's looking into the future. And when we look at the future, then we are forecasting, and everyone needs to be involved in what they are doing. So you liaise, you look at your income. So you go to your conveyancing department, you go to your litigation department, you go to your third-party claims department, you go to all your departments, estates, and then you ask them, what are your budgets? What are your targets? And with budgeting, you would find even for your performance review, you can base it on that, because now you are giving each department to be specific and say, if we can achieve this, and then you compare with the actuals at the end of that period. Okay, so it's kind of like involving, it takes all the companies. With other entities, normally what they do is that they set aside days or for meetings for budgeting, or they can even go out and have a conference if someone who facilitates the budgets, and then someone is collecting information, and then from that collecting information, then budgets are created, and they take it as part of their team building and ensure that every year end a budget is prepared and it's compared. Okay, so with our budgets, we also indicate our assumptions on how we feel our business will perform, assumptions on estimates like our depreciations, our bad debts. If we assume, okay, we are going to write fees of so much, is everyone going to pay? Are we going to collect all our money? So that is done through budgeting. Okay, so with the budgeting, what we prepare, it's more of like budgeted financial statements. It's budget financial statements. So those financial statements that I've shown you, we then just come, we take into detail, we narrow them into our financial statements so that for comparative sake, we can compare information. Okay, so we've got our budgeted income statement, budgeted like the balance sheet or statement of financial position. We've got our statement of changes in equity because it will show the profit that we are anticipating to have. It will have our budgeted cash flows. So normally with the cash flows and the income statement, normally we show them in detail. Okay, and then after showing them in detail, then we can narrow down and do summarized, or everything can be done in detail. Even your balance sheet, you can show it on a monthly basis because it will feed, the information feeds from one worksheet to the other, from one, it's the same information that gives you the budgeted financial statements. Okay, so normally when they say we want a budget in our examples, they are more of like talking about an income statement. So that's your budget. But with myself, I call it a budgeted income statement or a budget income statement. What does it have? Our income statement, our income, our expenses, then we get our profit. Okay, why is the income statement important? Then, like what we've discussed before, we can determine the firm's profit. It contains of income and expenditure, so we are forecasting our income, how we expect to perform. If our income is seasonal, then we can show it accordingly. We control our expenditure accordingly. Then we'll be like around June, then we are supposed to control our expenditure in this way. If our income is like steady, the same income throughout the year, then our expenses, how can we control them so that we can save? So that is the good part about budgeting. Okay, and our budget, our income statement, budgeted income statement would also include non-cash expenditure. So we've got our depreciation, we've got our bad debts, things that we anticipate to say they affect our performance. We show them in the income statement. Okay, and then the next one, we will concentrate on the income statement and the cash flow. And even our assignment, it requires a budget, which is our budgeted income statement, as well as it also anticipates a cash flow. So when you are preparing them, you have to prepare them separate, present them separately. Okay, and our cash flow forecast, it feeds more of like from the budgeted income statement. And now we are just having a look at how we are going to collect our income. So we'll be told to say we anticipate to collect our debtors in the same month, or maybe 50% will pay in the same month after presenting an invoice, and then the 50% will be paid in the following month or over 2 months. Then you also apply those assumptions accordingly. Okay, so our income, we are now calling it cash flow, cash inflow, cash inflow. Okay, so with our cash inflow or our receipts, remember our cash flow is the same as our cash book layout. We've got our receipts, what we anticipate to receive. It also includes even loans. If we are anticipating to receive a loan, then it's part of our cash flow. If we are anticipating to borrow even from the directors, interest for our investments, it's part of our cash flow. Okay, so all that we take them into account, and then we build up our movement of the cash as we anticipated. Okay. And the other thing that is different between the income statement and the budget and the cash flow is that in the income statement, say for instance, we anticipate to pay bonuses. So we budget for them. Remember budgeting. We budget for them so that in November we'll be able to pay. So we are putting provisions into our expenses, putting provisions so that at the end of like November, we have that money in place, we can pay. So we then start and say over the 12 months or 10 months, how much are we anticipating to pay? We're anticipating to pay 60,000, 60 divided by 10, we apportion it in our budget. But in our cash flow, because we are not going to pay bonuses immediately, then in our cash flow, we will show when the bonus is paid, when the bonus is paid, when the tax is paid, the full tax amount is paid. But in our budgeted income statement, we can show this is our profit, this is the tax on that profit, tax on that profit. We carry it forward, we show totals. Okay, happiness. So cash flow contains only cash or only payments and receipts, payment and receipts according to the way that they occur in our books. Like if it's our bank statement as well as our petty cash, all those movements. Anything which is not of a cash value that we normally journalize then does not form part of our cash flow. Yes. Yes, that's why you see when we are recording our books, we record on an accrual basis where we say we have raised an invoice, we realize our fee, but that fee does not mean that we've collected it. Okay, then we created data. Hence, we created data to show that we collect it into the future or collect it once our data pay. So that is the income statement. But the cash flow, it's things as they happen money-wise. As they happen, we receive, we pay, we receive, we pay, we receive, we pay. We prepare it that way. Happiness. So we're going to show an example. I've got an example, and then we'll have our worksheet where we'll present our budget. Okay. Let me now share our question, and then we discuss it, and we take it from there. Okay. This is our budget. Okay, so we're given a question. In preparing your budget and cash flow for the year ended 31 December 2020. So budget, remember it's the income statement, cash flow forecast for the following, for the year ended 31 December 2024. So we are looking into the future, Currently we are in January 2024. So we are looking into December 2024. We are preparing our budget. Usually we prepare it a year before. Okay. The following information was received from your accountant. Okay. So monthly expenses like current salaries, they are sitting at 60,000. Director's salary, it's 20,000. Rent, it's 12,000. Telephone and internet, 2,500. Monthly rental copier, 1,800. Office expenses, 1,500. Okay, and then we are told we've got depreciation, which is on a monthly basis for computer. So we've got computer equipment only, which we are depreciating, 1,500. Salaries will increase by 5% in March 2023. So this is now 2024. Sorry for that. This is 2024. Because we are looking at 2024. So I think when I was checking the example, then I overlooked changing these figures. Okay. All right. So Salaries will increase by 5% in March 2024, including that of the director. Rent will increase by 7% in August 2024. So you need to do your tax very well. You invoiced 100,000 on a monthly basis in 2023. Okay, so this is past, and then it shapes us into the future. We use it to build into the future. Our past, we utilize it for the future. Okay, you are planning on increasing the monthly invoicing with 5% from March 2023, which means January is going to remain 100,000, February 100,000. Starting March, then your plan is to increase your invoicing. So probably you have looked at marketing, you have looked at other business enterprises, then you are going to increase from March, and then with 2.5% in August 2024 going into the future. So you are now looking at other avenues that you can grow the business. Good thing about budgeting. Okay, and then debtors pay an average of 80% of the invoices during the month of invoicing, and 20% in the month of invoicing, in the next month of invoicing. Okay, so we are now given the cash flow part, So you should be able to distinguish this part. Is it going to the balance sheet? Is it going to the income statement? Is it going to the cash flow? Sometimes both parts would go to the income statement, that would go to the cash flow. Okay, and then you are told your bank balance on 31 December 2023 is 35,000. You are required to prepare or you are required to draw up an income statement, profit and loss budget, and a cash flow forecast for December 2024 in column format. List each income and expense item separately. So you are told don't lump up things, list them separately. Okay, let's come up with an example. So what I'm going to do is that on our same worksheet, I hope you can see this. On our same worksheet, we are going to add our budget income statement, and we'll also add our budget, our cash flow, forecast. Okay, so the format of our cash flow, I'm going to share our question side by side so that we more of like develop it. Okay, I'll stop sharing and then I'll come back again to the screen so that we can clearly show. You might not see everything, because I know with these things you might not see everything. Or at least I want you to see side by side, then you don't see everything. Okay, so I'm going to stop sharing and then I'll share again so that we ensure that you see everything. Okay, this is our screen side by side. Try to enlarge it. Okay, so we start with our budgeted, with our income and expenditure budget. Okay, so our income, so then we'll start with the income on top, which is our fees, and then we then tabulate. So our tabulation would be the months, which is January. Our month are flowing from January 2023 2024 to December 2024. Okay, January. Then we like that, September 2 should take us to December 2024 like that. So those are our various months. Okay, like that. And then we show our fee. Okay, so this is our income, and then we do our expenditure. Okay, so our income, our fee, we are told that you invoiced 100,000 on a monthly basis in 2023. You are planning on increasing the monthly invoicing with 5% in March, which means 100. We said we are going to remain with the same amount. 2,100, same amount. February, same amount. But in March, we are planning to increase by 5%. So it's going to be that one of February plus 5% multiplied by 1.05, or plus 5% off, which is 5,000, like that. So it will remain like that. We anticipate to have the same every month until August, where we are going to increase by 2.5. We are going to increase it by 2.5%. So I'm just going to copy until August. Then August is going to increase multiplied by 1.025, which is 2.5%, or this multiplied by, yeah, I think that's it, 100 plus 2%, 100 plus 2.5%, like that. Okay, it's just formulas, So it's just your application. You can do it manually, you punch in manually. And then every other month, it's going to remain the same. Okay, this is our anticipation. This is growth that we are anticipating, we are budgeting for the future. So we can do our total income. So income, if we had interest income, if we are anticipating to receive interest, then we would show the interest that is receivable. Okay, so this is our total income. If we had other income that is not our fees, then we'll also show it as other income, as what is anticipated. Okay, so the top part is our month, which I'm going to do a bit of cosmetics, edit it up like that. Our income, I'm going to apply, do a bit of some cosmetics and show our income like that. Okay, so I can as well just try to have it nice, put commas so that these amounts can look much nicer, like that. Okay, and also what I'm going to do is I'm going to freeze. Let's freeze view. We freeze columns so that we can view what we are doing. That's the good part about using Excel. You freeze columns like that, then it can show us kind of like a holistic view. Okay, so that is our income. Then let's move into our expenditure. So we start with salaries. Salaries and wages, and then director's salary. And then we've got rent. I think I was supposed to make it bold. And then we've got telephone and internet expenses. And we've got copier rental. And then office expenses. So office expenses, I think, like your stationery, your groceries, your fuel. So they just to minimize. And as part of our expenses, we've got depreciation. Remember, it's part of our expense. Computer. So why depreciation is an expense? We bought our computer equipment. We bought it, it is ours. Now we are realizing the expense over a period of 3 years. So on a monthly basis, we calculate how much is it on a monthly basis. We are taking it, we are decommissioning it into our expenses slowly. That's how it is done, how it is acceptable in the accounting field, and even the taxman would accept that. So we look at salaries. They say salaries will increase by 5% in March 2024, including that of the director. So which means January, February, we are remaining the same, 60,000, 60,000. And in March, we are increasing by 5%. This plus 5% of that. So which is multiplied by 1.05, like that. So you can do your formulas. 5% of 60,000 is 3,000 plus 60, we get 63. So our salaries going into the future, they're going to be 63,000. So we carry them over up to December. We are copying to December. Nice thing about using Excel, we're done with salaries. We look at our director's remuneration, which is 20,000, also remains and only changes in March. So which is by 1.05. Okay, and then we copy this, remains the same. So we are copying it, remains the same. Okay, our rent will increase in August. So which means our current rent will go on until July, 12,000. We copy it until July, and then in July it increases by 7%, and then from then on we start paying 7%. Okay, no, we don't copy here. We first of all copy and then like that. Okay, telephones, we are not given any information, so which means our telephones, they're going to remain. Our cell phone companies are lenient, so they're going to remain the same. And copier, we don't anticipate any increase. Maybe it's a 3-year contract of the same amount, then we like that. And then our office expenditure, we don't anticipate any increment, so we are given 1,500, and then we copy it until December. Okay, and we look at our computer depreciation per month. We are told this is monthly, so I'm starting in March. I should start in January, like that. We anticipate it to be the same. And then what do? We are done. We do our monthly. We add up total expenditure. Like that. So what is our total expenditure? We add up our expenses. Like that, that's our total expenditure. Like that. Bold. Kind of underline. So if we can check what is our profit. Income. Oh, we're running at a loss. Income minus expenses, we get our profit. Like that. So this is the profit that we are making on a monthly basis. Because we are budgeting, you can see the profit was 700, and then in March it went up to 1,700. It remained. So we are looking at ways in improving our profits. That's the nicer part about budgeting. And if you can grow it bigger than this, then you would find you will have happiness. the business will continue. Okay, so this is our profit. So, and then we can calculate if it was an incorporated, then we can calculate our tax expense. %27, and then this is the tax that would be payable to the taxman. Okay, and then we've got, so this is before tax, profit and loss before tax, and then we've got our tax expense. So, which means my highlighting here, let me change it to lighter bold, like that, and then our profit and loss for the year. So if you can have a look at this, it's more like the same as our financial statements that I prepared, the detailed ones that we prepared. Same concept, but we are just now looking into the future. Same concept, looking into the future. Hence, I started from financial statements. So our profit before tax minus our tax, we get our profit for the year. Profit for the year. So we copy up to December, then we underline like that. Happiness. So I can make this one just a bit of cosmetics, and then I gray it out. Maybe a little gray. Okay, like that. And then we can do totals. We can as well put totals for everything. So totals. Our totals. So our totals will basically run from January to December to show us our total income, and here it will show us our, if we had other incomes, then it would show us. And then for our expenditure, we do the same. We add, it will show us our total salaries for the year, for the 12 months. And if we can drag and copy, it will show us our total, everything. You can see a total. Let me like that, and then if we drag, we get our formulas right. We get our total tax for the year, we get our net profit for the year. So we're more of like just making 19,000 out of all this. I can imagine the previous year we were making 700 before tax. So we can then make our decisions. Are we making enough money? Are we able to, is this not too tight on us? Are we able to cover our cash flows? Do we need to borrow? So now we make it by doing our cash flow. Okay, so with our cash flow, the format is the same. The format is the same. So what I'm going to do, basically, I'm just going to copy. I'm going to copy this so that we do not spend a lot of time. Then we develop it from there, and then we paste it into our cash flow. Okay, and then we are now changing it into our cash flow forecast. So instead of income, now it's going to be our receipts. What are we receiving? Okay, so we are going to receive from our debtors. Okay, and expenditure, it's our payments. What are we paying? Are we going to pay for the computers now? No, we are not paying. So this element is going to go out. But everything else we're going to pay as is. And then when we look at our debtors, let's look at our debtors. Okay, this part, our debtors pay an average of 80% of the invoice during the month of invoicing and 20% in the current month. So for January, we are collecting December 20%, which is 100,000 multiplied by 20% plus 80% for the current month, 100,000. Okay, so let's split it to make it easier. Let's make data's 80% like that. And then we are going to show data's 20%. Okay. All right, so I'm going to clear this. Delete. So the 80% is for the current period, current month. Okay. So if we can go to our income statement in January, we are anticipating 100,000. Out of the 100,000, we anticipate 80%, multiplied by 80 by 80%. Okay, so that's our 80%, and then we anticipate 20% from December. So December is 100,000. So I'm going to calculate it manually because December 2023, we don't have a schedule for that. Multiplied by 20%. Okay. So in February, we're going to anticipate 80% of February. So we will copy the formula. Feb multiplied by 80%. So this is going to remain for the other months. So it copies the formula when we do that. You can copy and then it will work it out for you. Nice. And then for the 20% now, for January, we get it in February. So 20%. And then for March, it's the February amount. February, we're going to get 20% in March. In April, we're going to get 20% in March. 20% of 105 is going to come in April. Just like that, you do that, you do to the end, then you copy it like the same formula, and then you do the totals. So this is the income that we are going to receive, 1261. And with income, with our receipts, okay, with our receipts, so it's different. If you can compare with the income, 1261, our budgeted income, 1263, and here it's 1261. It's because of the timing difference in receiving and invoicing. You invoice, you receive, you invoice. So you can see there's a 2,000 that we are not going to collect now. There's a 2,000 that we are not going to collect now. Okay. And then we look at our salaries. Salaries, we're paying them in the very month. We assume usually salaries and wages, when we are doing our budgets, then it includes everything that it's a total cost to company. So it includes UIF, SDL, pay as you earn. So we just put our budget as is, including all that. So we anticipate to cover all that, it's 60,000. The director to cover everything, it's 20,000. So it's total cost to company. So we assume, our assumption is that in January, end of January, we make sure that we pay SARS. So we are clearing our bills, we are doing everything. But if we're going to pay SARS, say on the 7th of February, then our cash flow position was going to change, and that then we show what we are paying as net for the net salaries, and then the pay as you earn, we show it in the following month. Then we'll have a leg of that default. But in our expenses we show for that particular month. January's expense should be January expense. February expense should be February expense. But payments, we do them according to payments with the information that we are given. Okay, and then here we then call it total payments. Okay, and then total payments. So I'm just gonna, and then here we'll have our closing balance. Okay, so with our total payments, if you can have a look at payments, we are more of like paying 1217.800. Why? Here we've got 1235. What's the difference? Well, the reason why is because the computers, we bought them already. They are existing. We are not paying for them now. So it's just a timing difference because of the requirements of expensing that is there, that we call depreciation. You can't expense that asset once off. You do it over a period of time. So this is the 18,000 that is causing the difference between our cash and our income statement. Okay, so with the closing balance, and then we are told your bank balance at 31 December 2023 is 35,000. So that will assist us in determining our opening balances. Okay, so our formula, I'm just gonna change it a bit so that we, and also our highlighting, we'll change it. I'm just going to undo this highlighting. Pick the wrong one, not view. Okay, so our receipts are going to be these receipts, but we've got what we call the opening balances. Opening balance. So our opening balance, that is the cash that we have in the bank, like in January. So I'm going to change, this is in a date format, so I'm just going to change it to a number format like that. So this is the opening cash, this is the total income, and then what we do, not total income, total receipts. So it's an inflow and outflow. So this part we call it an receipts or inflow. Inflow of funds, cash inflow, cash inflow. Okay? So it's coming in, cash inflow, receipts or cash inflow, payments or cash outflow, like that. And then here we've got our total payments and cash outflow. And then we do show now, we can show our total cash available, total cash available, because remember we've got an opening balance, so we can build in and show this is our opening plus our receipts, this is our cash that is going to be available. That is going to be our cash that is going to be available. Let me leave it there and bold it. Okay, so maybe here I'm not going to bold for now, since we're changing the format. This is the cash available, our opening plus our receipts. Then we get our total cash available. And then from the total cash available, then we make payments. These are our payments, our outflows. And then from our payments, so if we can, our closing balance would be total cash available minus total payments, like that. Or you can say opening plus receipts minus cash, you get your cash flow. So I've just added this one so that we know what is at the end of the day our cash available. Okay, so this is our formula, this is our closing. So closing for December will become opening for February, like that. It's opening for February, and we apply the same concept, and here the closing, it's the same, so we apply the same concept, and then we go on top. For March, it's going to be February opening, so we apply. So if we can copy, we drag like this, we are applying the same concept. Okay, so in December we are taking November, that is, and then we end up with a 78,800. And on our total, we start with the opening balance from the beginning. Now we are now doing for the full 12 months. Okay, from the beginning, which is this one. So this is our total. We are starting with the beginning. We add, and then we pick up the formula like that. So it will give us, this is the total cash which was available opening plus the cash that we received. We get to our total, and then the payments, we paid so much, and when we add up like that, we get our total. So these two should give us the same answer, the same answer, the same answer. Because this is December, this is our totals. So totals, it's just saying, let me bold them. So totals, we're just saying total of, okay, like what I did with the income, let me also freeze this part, view, freeze this part so that we are able to see the other end. So this is our opening balance for the whole year. Total income collected 80%, 20%, and then opening cash plus what we've received 129,600, and then salaries we paid 750,000, directors 250,000, rent. So you can now be able to put your, if you want to do your calculations in terms of percentages, you can be able to do that using the totals, or you can do it on a monthly basis. Especially with the income statement, you can come and say, okay, directors, what percentage of income did they receive? This divided by the income. What did they receive? 19% or almost 20% went to directors. What went into salaries? Salaries divided by, as part of income, 59% went into our employees. Or you can compare directors as compared to the expenditure. How does it compare to the whole expenditure? It's still like 20%. It's now more because, yeah, of reduced amounts. And then it's the same when you're doing with your salaries. What percentage was it of expenses? So you use it for management purposes. So in future, when you're forecasting, you are able to forecast further compared to income, compared to total expenditure. Then you can have a global look at your figures. You can even analyze in January, what was January income compared to the total income. It was 10%, 20%, 5%, 4%. That's how you then utilize this for management purposes. Okay. All right. So we are done with our budgets. This is our last webinar. And I wish you all the best in your assignment, and I hope this will be very beneficial. And if ever you feel you need to have a look, go back to the videos, you have a look at how I was doing it. And if you feel you need the templates, you can liaise with Eugenia. And then you say, okay, can you make the facilitator share, or even on the forum, if you want the templates, then you can ask me to share the templates with you. Then you can remove the figures, then you utilize the templates for your own assignments. Okay, so I'm not going to get into the assignment because it is the same. It is the same theory, the same concept. I have attempted to cover all that through doing practical examples for you and giving you more information just for your insight, for your practice. And yeah, this is it. Thank you so much. It was nice to be your presenter, and I hope you have enjoyed my lectures and you were empowered. And when you proceed with your practice management, other courses, you'll be able to apply the same theories, and in your day-to-day practice, when you continue, you'll be able to also apply the same theories. And where you need assistance, then you can look for me. I'll be able to do your trust accounts, your business accounts, help you with your budgeting, with your practice. Thank you. Okay. So I'll stop recording from here. Bye-bye.